Good morning to every one of you. This is the third video in the subject valuation of goodwill and shares, and here we are studying the valuation of goodwill. That already in the two videos, that arbitration method, average profit method, and super profit method have been discussed. And here in the third video, we are going to give the explanation related to the, capitalization of the profit method. In the capitalization of the profit method, we have to find out the normal capital. Actual capital is there. Capital employed is calculated through the balance sheet. Actual capital employed we have discussed in the super profit method also. So need not be explained again in details. Then normal capital is calculated by average actual maintainable profit. Average actual maintainable profit, otherwise average actual profit or actual profit into 1 by normal rate of return. Otherwise you can make the formula that actual profit by normal rate of return. This will give the normal capital. Here in the two illustrations have been given for explanation of that. In the first illustration, you have to calculate about the normal normal capital employed. For that average profit to be calculated. That profit is, I think, given in the profit is given. That illustration 7 and 8. Illustration 7, you find that total profit into, and thereby average profit is calculated without any adjustment. And that in the two adjustments are there. One is the manager's salary and another one is additional future expenses. Manager's salary should not be paid in future, thereby that should be added. And future some expenses to be incurred, that should be deducted to know the average maintainable profit. And from that you have to apply that here that rate is given as 10%. Thereby 46,000 into by 10 will be giving 4,60,000. And normal capital, actual capital employed is 3,90,000 only. But normal capital is 4,60,000 in the problem. And thereby earning a profit of 70,000. That is earning a goodwill of 70,000. Difference between 4,60,000 minus 3,90,000. See the second illustration 8, balance sheet is given. From the balance sheet, you have to find out the net tangible asset, otherwise capital employed. You have to deduct only the loan, bank overdraft, sundry creditors, provision for taxation, only to be taken, and other expenses excluding goodwill, because only tangible assets should be taken. Goodwill should not be taken here, even then it is given. Then a new value of goodwill we are going to assess. Then that from that you have to find, you have derived that 1,39,000 is the net tangible assets. Then total profit before tax is there, then tax should be adjusted, and from that you got 24,000. From that rate being 12%, then that 24,000 divided by 12% means that will be given 2 lakh. Then 2 lakh is the normal capital, but the company is having 1,39,000. With the 1,39,000 capital, it earns profit. But with the 2 lakh, only that profit to be earned in the case of the industry. Thereby, the goodwill is there. That is normal capital minus capital employed. Thereby, that is very easy calculation. Only thing is you know about the calculation of the capital employed. Keep in mind only deduction of the current liabilities. And when you are adding that, asset side, only tangible assets. Fictitious assets should be excluded. Otherwise, in another way, you have to calculate from the total long-term capital minus fictitious assets. That would be okay. Okay, thank you very much.